talk to me about this deal. What was the strategic rationale, and also was it a good deal in your opinion, and why?
Yeah, so basically, Human wanted to solve the vast amount of online bots and fraud that was going on. And although they focused primarily on securing websites such as, your email, any website that you really log into to verify if you're a bot or not, they want to acquire Perimeter X because they focused on detecting bots on social media platforms like Twitter, Instagram, Facebook, things of that nature. And because of the market domination that Perimeter X had in that market, they thought it would be smarter to just buy out that company rather than going head on and trying to compete with them. And overall, I do think it was a smart move. I think the transaction went smoothly. They paid a fair price for Perimeter X, although the amount isn't disclosed. I think both parties came to an agreement that they were happy with, and everything worked out well.
So Human Security's rationale was they just wanted to buy the market leader to expand into that space. Why would Perimeter X be wanting to sell, I guess?
That's a good question. Because of the other market players that were in the space, they thought it would be best to be secured by a company that had a total greater market share when it came to bot mitigation and bot detection. So that being said, they saw the potential of acquiring Perimeter X, and both parties essentially saw the benefits to the acquisition.
Okay. And when you say they paid a fair price, you don't have to tell me exactly what the price was. Like, what was the ballpark valuation multiple paid for this company?
I'm trying to do the math in my head, but if I was to ballpark, it's 10 to 15x revenue.
Okay, 10 to 15x revenue. And this was back in the summer of 2022. So why do you, when you say like 10 to 15x revenue is fair price, like why do you say that's a fair price?
Looking at the other transactions that were happening in the cybersecurity space, that was typically the multiple that we were seeing alongside the equity and enterprise value that we were getting and able to find for comparable companies, all fit within the same range that Perimeter X was sold to Human.
Okay, so like you're going off of precedent transactions basically. Okay.
Yeah.
So what are some of the precedents that you guys used?
Oof, I don't know. Remember.
Okay. And then if I'm a growth equity investor and I'm trying to, let's say I had all the information I could possibly want. Okay. Let's say like information is not an issue because I'm doing due diligence on these companies and I can ask them for whatever information I want. And I'm trying to decide what valuation I want to invest at. Do I want to invest at 10x? Do I want to invest at 15x, 20x, 40x, right? What are like the main things that you would look at to determine, what an appropriate multiple is? Again, going back to this question of like, hey, what's a fair price to pay for this company? Like, what if this was SaaS companies? Like, what are the main things you'd be looking at?
Definitely, I think like a revenue multiple is one. If it is a SaaS business, then maybe looking at a multiple that compares their price per subscription to revenue, maybe the number of subscriptions that they have to the revenue, the cost of their COGS maybe to net income. Yeah, I'm just trying to think, but
you say COGS to net income?
Yeah.
Okay, that doesn't even make sense. But because I don't know, like that's not a ratio that anyone
okay.
Right? But like let's just back up for a second. Okay, so a couple things. I don't know if anyone has ever asked these questions, but I would say like honestly, if you are interviewing with a top tier growth equity firm like Insight, I would not be surprised if they ask you these types of questions.
Yeah.
First, the basics, regardless of whether it's a buy side firm or sell side firm or whatever. Like, if you're gonna talk about doing 2 deals during your summer internship, like I think you need to know more than what you're demonstrating here, right? Like,
sure.
You can't like not even know what the company's business model is, how they make money, are they SaaS, are they not SaaS? You can't like say, hey, I only came in really late in the deal, and so I didn't, get to touch it. Like at a minimum, just knowing what the company does, right?
Yeah.
I'm pretty sure I don't know anything about this company, but I'm pretty sure it's probably a SaaS company because that's just what most software companies are these days. Like people aren't selling like licenses anymore, right? They're not like on-prem software. That's like very not the flavor of the day anymore. And then so like if it's a SaaS business, and the reason why I decided to ask you about this deal out of the 2 that you worked on is because if you're interviewing for a growth equity role, growth equity firms love investing in SaaS. In fact, like a lot of tech, even tech PE, like they love investing in SaaS because it's got the sticky recurring revenue model that all PE investors like, right?
Yeah.
It's consistent, it's predictable. As long as the unit economics are good, then you can scale the heck out of it, right? So like, I think like when I ask you like, hey, is this a SaaS company? What are the main things you'd be looking at? Like for tech buy side interviews, like they're gonna want to know that like the key or like the most important KPIs or metrics for evaluating tech companies. For a SaaS company, it's gonna be lifetime value of the customer, and it's gonna be they call it CAC, which is customer acquisition cost, right? Or a cost to acquire a customer, however you want to think about it. But that's what they mean by like unit economics, which is like if I really double click into my revenue and drill down to like its most granular level, which is at the individual customer level, how profitable is each customer for me.
Yeah. Okay.
How much did it cost me to acquire this customer, which is like the sales and marketing costs, like how much did I have to spend on marketing and advertising and all this stuff, PR, blah, blah, blah. And then how much did I have to pay my salespeople in terms of like commission and whatever. All of that goes into like, if I spend $100 million to acquire these customers and I acquired, 100 customers, that means the CAC is $1 million. Right? So it's not going to be that high, but that was a bad example. But anyways, it's literally like, that's how you calculate cost of acquisition. And then lifetime value is literally like, okay, it's a subscription business and this company is going to pay me X dollars per month or X dollars per year, right? And then how long are they going to pay me for before they churn? If a company pays you $100 a month and they're only going to stay with me for 12 months, then the lifetime value is going to be $1,200.
Yeah.
Right? But actually, the more strict definition of lifetime value is not even just the revenue, it's the gross profit times it's the gross profit times like the length of time that they stay with you. Sure. Because cost of goods sold is considered the variable cost, right? So meaning like every month I have to service you as a client, there's a certain amount of cost associated with that. So my variable cost has to be deducted out. And then like the gross profit is basically my, I guess you call it like my contribution margin or variable profit. Or so it's like revenue is $100 a month, but it costs me $10 a month to service this client. Then that's $90 of gross profit per month. And if they're going to stay with me for 12 months, then that's whatever, 900 plus 180. So 1080, right, will be the lifetime value. And so the holy grail of SaaS, evaluating SaaS companies, like if you can only pick one metric or one ratio to look at, there's not any of the stuff that you talk about. It's not revenue multiple. It's not like how many subscriptions they have. It's not COGS or net income or any of that. It's LTV to CAC.
LTV.
Lifetime value divided by cost of or customer acquisition cost. Basically, for every dollar I put in, how many dollars is going to spit out? So ideally, you're not a good, healthy SaaS business unless your LTV to CAC is at least 3x. For every dollar I spend to acquire the customer, I want to make at least $3 back. Obviously, the higher the better. There are SaaS companies out there that's like LTV to CAC is 6 or 8 or 10 or whatever. Like the higher that number is, the more aggressive you want to be in acquiring as many customers as you can. Because like if I gave you a machine where you can put in $1 and it's gonna pay $10, like you would just pour gasoline on that, right?
Yeah, so makes sense.
That's what like an investor would be looking at first and foremost. Hey, if you like this video, click the like button and hit subscribe to get more content like this.